When everyone's celebrating, that is, when I start worrying. I am Charlie Munger, and I am going to tell you something that might ruin your weekend. When the Dow Jones breaks 50,000 for the first time in history, and everyone's popping champagne, that is precisely when an old man like me reaches for his wallet to make sure it is still buttoned up tight. You see, I've lived through enough market cycles to know that the most dangerous phrase in investing isn't "this time is different." It is actually "let's celebrate." Because when the crowd is celebrating, they've stopped thinking. And when people stop thinking, they start behaving like lemmings marching toward a cliff, convinced that if everyone else is jumping, it must be the right thing to do. So let me be your cranky old guide today. I am going to walk you through what is really happening behind this historic rally, and more importantly, I am going to teach you how to think about it using the mental models that have kept me solvent and reasonably sane for nearly a century. The 4 pillars holding up. When I look at any market rally, I don't get excited by the number on the screen. I ask, what variables are actually supporting this valuation? Strip away the confetti and champagne, and every bull market rests on 4 measurable pillars. 1. Corporate earnings. 2. Interest rates. 3. Liquidity. 4. Risk appetite. Right now, the narrative is intoxicatingly simple. Tech is crushing it, and the Fed's going to cut rates. Beautiful story. Terrible analysis. Let me show you why. Pillar 1. The earnings mirage. Yes, corporate earnings look strong. On the surface, the magnificent 7 tech stocks are printing money. But here is where you need to employ what I call inversion thinking. Instead of asking, what could go right? Ask, what happens if this goes wrong? Strip out those 7 companies, and what is the earnings growth of the other 493 stocks in the S&P 500? Mediocre at best. You are looking at a market held up by fewer and fewer columns. That is not strength. That is fragility masquerading as momentum. And here is the kicker. Much of that tech earnings growth is predicated on AI spending that has yet to generate proportional revenue. Companies are pouring billions into AI infrastructure on faith, not proven ROI. I've seen this movie before. It was called the dotcom bubble. And the ending wasn't pretty. Mental model alert. Lollapalooza effect. When multiple forces, momentum trading, FOMO, narrative, euphoria, passive index buying, all push in the same direction, you get extreme outcomes. The trouble is, Lollapalooza works in both directions. The same forces that drive markets to irrational highs can flip and drive them to irrational lows. Pillar 2, the rate cut fantasy. Now let's talk about this interest rate cut fantasy. This rate cut delusion that has got everyone giddy. The market is pricing in rate cuts like they're a certainty. But here is what the market seems to have forgotten. The Federal Reserve doesn't work for stockholders. It works for price stability. And last time I checked, inflation wasn't dead. It was just taking a nap if inflation resurges even modestly. Those rate cuts evaporate. And if rate cuts don't materialize, what happens to your 50,000? Let me introduce you to opportunity cost thinking. If bonds start yielding 5 to 6% with zero risk, why would any rational person pay 25 times earnings for stocks with questionable growth prospects? The market's current valuation assumes a Goldilocks scenario. Rates fall, inflation stays tame, earnings keep growing, and nothing goes wrong geopolitically. That is not a forecast. That is a fairy tale. Mental model alert, base rate neglect historically. When markets reach all-time highs on elevated valuations, the subsequent 10-year returns are below average. Not sometimes, usually, but everyone's ignoring the base rates because this time feels different. Pillar 3, the liquidity trap. Here is where it gets interesting. And by interesting, I mean terrifying. For 15 years, we've trained an entire generation of investors to believe that central banks will always provide liquidity when markets stumble. The Fed put, the ECB put. The Powell pivot. It is like giving a teenager unlimited access to your credit card and then being surprised when they develop no sense of financial discipline. This creates what I call central bank dependency syndrome. Markets can no longer function without the IV drip of cheap money. Remove it, and you don't get a healthy correction. You get withdrawal symptoms. And here is the part nobody wants to discuss. Central banks have limited ammunition left. Rates can't go to zero again without triggering a currency crisis. Balance sheets are already bloated. The next crisis won't be solved by the same playbook, because that playbook's already been used up. Mental model alert. Second, order consequences. Everyone focuses on first order thinking. Rate cuts are good for stocks, but second order thinking asks, what does it mean that we need rate cuts to keep markets afloat? It means we've built a system that requires perpetual stimulus to avoid collapse. That is not a healthy economy. That is addiction. Pillar 4. Risk appetite in the age of delusion. Let me tell you about risk appetite. When everyone's confident, risk premiums compress to nothing. People start paying luxury prices for mediocre assets because they've forgotten what risk actually feels like. I look at credit spreads. The premium risky borrowers pay over safe government bonds, and they're at multi-decade lows. Corporate debt is at record highs. Companies are borrowing to buy back stock at peak prices. This is financial engineering masquerading as shareholder value. And the retail investor. They're leveraging up in options, buying meme stocks, and treating the market like a casino. When taxi drivers were giving stock tips in 1929, that was a warning sign. Today, it is TikTok influencers telling teenagers to YOLO their savings into zero DTE options. If you need to be told why this ends badly, you haven't been paying attention to history. Mental model alert, the availability, heuristic people overweight recent experience, because the last 15 years rewarded buying the dip. Everyone assumes that is a permanent feature of markets. It is not. It is a feature of unprecedented monetary stimulus. Remove the stimulus, and the dip becomes a crater. The AI bubble, a special kind of madness. Since we're being honest, let's talk about the elephant in the server room. Artificial intelligence. I am not saying AI isn't transformative. It is. But transformative technology and profitable investment are two entirely different things. The internet transformed society and vaporized trillions in shareholder value along right now. We're in the narrative phase of the AI cycle. Big promises, massive spending, minimal revenue. Companies are valued not on what they earn today, but on fevered dreams about what they might earn in a decade. Here is my question. If AI is as transformative as everyone claims, doesn't that mean massive disruption and displacement? Doesn't it mean entire business models become obsolete? Yet somehow, the market believes AI will create wealth without destroying any. That is not logic. That is wishful thinking. Mental model alert. Circle of competence. Ask yourself honestly, do you understand the AI business models you are investing in? Can you articulate how these companies will generate returns on their massive capital expenditures? If not, you are speculating, not investing. And speculation works until it doesn't. 5 principles for surviving what comes next. All right, enough doom and gloom. You didn't sit through this talk just to hear an old man complain. You want to know what to do. So here are 5 principles I've lived by. 1. Invert. Always invert. Don't ask, how can I make money in this market? Ask, how can I avoid losing everything when this market corrects? The asymmetry is crucial. You need just one catastrophic loss to wipe out years of gains. 2. Expand your circle of competence slowly. Don't invest in things you don't understand just because they're going up. I passed on tech stocks for decades, not because I thought they were bad businesses, but because I didn't understand them well enough to bet big. Better to miss out than to blow up. 3. Prepare for trouble you can't predict. Keep liquidity, keep purchasing power. When everyone else is fully invested at peak prices, The person with cash and courage can buy world-class assets at distressed prices. That is how wealth is really built. 4. Avoid debt like the plague. Debt turns setbacks into catastrophes. In a falling market, leverage doesn't just amplify losses. It forces you to sell at the worst possible time. I've seen brilliant people destroyed by leverage. Don't be one of them. 5. Never stop learning. The moment you think you've figured it out, the market will teach you humility. Read, study failures. Learn from other disciplines. Psychology, physics, biology. The best investors are polymaths, not specialists. Mental model alert, margin of safety. Don't buy something at fair value, buy it at a significant discount. That margin of safety is what protects you when your analysis is wrong. And trust me, sometimes it will be. The truth, nobody wants to hear. Here is what I really think. This 50,000 Dow isn't a triumph of capitalism or innovation. It is the inevitable result of 15 years of financial repression, where savers were punished. We've created a system where people are forced into risk assets not because they want to, but because leaving money in cash guarantees a loss to inflation. That is not a healthy market. That is a hostage situation. And when the music stops, and it will stop, a lot of people holding overpriced assets are going to discover they were playing musical chairs with their retirement. 3 questions for you. So let me leave you with 3 questions. Don't just scroll past them. Actually think about them. Write down your answers. Zone. If interest rates stay higher for longer and rate cuts don't materialize, what happens to your portfolio too? Can you explain, in your own words, how the companies you are invested in will generate returns over the next decade? 3. If the market dropped 40% tomorrow, would you panic and sell? Or would you have the liquidity and courage to buy? Your answers to those 3 questions will tell you whether you are investing or gambling. I am Charlie Munger. I've been wrong plenty of times in my life, but I've never been broke. And the reason is simple. I don't follow the crowd. I don't buy things I don't understand. And I never forget that risk is what is left over after you think you've thought of everything. The Dow at 50,000 is a milestone, but milestones don't determine your destination. Your decisions do. Now get out there and think for yourself. And for heaven's sake, stop learning from people on social media who've never lived through a real bear market. Your move.